Hello everyone, I'm your host CA Neeraj. Welcome to my YouTube channel Accounting Buddy. In business, various unique accounting terms are used. These are standard accounting terms used universally. In Part 1 and Part 2 of Chapter 2, Basic Accounting Terms, we have learned 35 accounting terms. Now in today's video, we will further learn 19 new accounting terms. By the end of Chapter 2, your learning of basic accounting terms will make you ready for the next chapter, number 3, Accounting Principles. So please sit back and watch the complete video. The accounting term number 16 which we are going to learn now is the term prepaid expenses. An expense which is paid in advance for a future accounting period or periods is classified under prepaid expenses. Benefit of prepaid expenses is realized in the future accounting year or years for which it is paid. Prepaid expenses are shown in the balance sheet under the head current assets. Let us now understand this further with an example. If the accounting year for a business is say 1st April 2023 to 31st March 2024 and the business has paid INR 120,000 as staff medical insurance for the period 1st September 2023 till 31st August 2024, the period of April 24 to August 24 falls under the accounting year 24-25. Please note that the full amount of premium was paid in the financial year 23-24. It is partly related to financial year 23-24, that is 7 months from September 23 to March 24, and partly for financial year 24-25 for 5 months, that is from April 24 to August 24. Therefore, INR 50,000 premium paid for 5 months related to the financial year 24-25 will be treated as prepaid for the financial year 23-24. For financial year 23-24, INR 50,000 will be shown in the balance sheet under the current assets as prepaid expenses. Next accounting term which we are going to learn now is the term outstanding expenses. The expenses which are incurred or are related to an accounting period but are not paid till the end of the accounting period are considered as outstanding expenses. Such expenses are charged to the profit and loss account of the accounting period for which they are related, and since they are still not paid till the end of the accounting period, they are grouped as outstanding or accrued expenses under the head current liabilities in the balance sheet. Let us understand this with an example. An electricity bill of say INR 15,000 for a business for the month of March 24 paid in April 24 will be charged to the profit and loss account for the financial year 23-24. However, it will be shown under the head current liabilities in the balance sheet at 31st March 2024 as it is still not paid. Next term which we are going to learn is the term income. Income means the profit earned by the business in the accounting year is the difference between the total revenue and the total expenses of the business and is denoted by the equation income is equal to revenue minus expenses. Let us discuss this with an example. Revenue of the business is say INR 20,000 and the business expenses are INR 15,000. Therefore, the income of the business will be INR 5,000. The term operating activities is the next term which we are going to learn. Operating activities are the primary revenue generating activities of a business. It includes all the business transactions that are related to the generation of income from the selling of goods or services. For example, Mr. X runs a business of car rentals and the primary revenue generating activity of his business is renting the cars on daily, weekly or monthly basis. In this business, the operating activities include car rental revenue and all the costs incurred in generating the car rental revenue. The term profit means the income earned by the business after deducting all the expenses of the business from its revenue in the normal course of the business. Profit of a business is looked into two parts, gross profit and net profit. Gross profit is the difference between the business revenue and the cost of goods or services plus direct cost of the business operations. That is, gross profit is equal to revenue minus direct cost. Let us understand it with example. If the revenue of the business is say 2 million Indian rupees and the various operating expenses are 1,62,500, then the gross profit of the business will be INR 937,500. Let us now talk about net profit. It is the profit earned by the business after deducting all the business expenses from the revenue. In other words, net profit can be calculated after deducting other operating expenses other than the direct cost from the gross profit of the business. Let us understand this with an example. The gross profit of the business is, in our example, is 937,500. Now, after deducting other operating expenses of INR 520,000, the business is left with a net profit of 417,500. If the revenue of the business is less than the total cost of operating a business, it is a case of net loss. Let us now understand the term trade receivables. When the goods are sold or the services are rendered to the customers and it is agreed that the customer will not pay immediately but promise to pay at a future date, till the amount receivable from the customer is actually received, the amount will be shown as trade receivables under the head current assets in the balance sheet. Let us understand this with an example. A business sold goods worth INR 50,000 to Mr. X and goods worth INR 25,000 to Mr. Y on credit. Both Mr. X and Mr. Y promised to pay after 60 days from the date when the goods were sold. Both the transactions are of credit sales. For business, INR 75,000 will be the trade receivables till the amount is actually paid by Mr. X and Mr. Y on the due date. Let us now understand the term trades payable. When a business purchases goods or receives services from a supplier or a service provider and both the parties agrees to settle the payment at a future date, in such a case till the amount due to the supplier or the service provider is actually paid, the amount due is considered as trades payable. Trade payables comes into picture when the business purchases goods on credit. Trade payables are shown under the head current liabilities in the balance sheet. Let us understand this with an example. A business bought goods worth INR 50,000 from ABC LLC company. ABC LLC company agrees that the business can settle the bill after 60 days from the date of supply of goods to them. This transaction is a credit purchase transaction. INR 50,000 will be considered and classified as trade payables till it is finally paid to ABC LLC company. Next term which we will learn now is debtor. Debtor for a business is a person or other legal entity which owes money to the business against credit sale of goods. Every legal entity or the person who are clubbed under the head trade receivables in the balance sheet are debtors for that business. Next term which we will learn is creditor. Creditor for a business is a person or it is another legal entity to whom the business owes money for goods purchased or services received on credit. All the creditors of a business are clubbed together and are grouped under trade payable and are shown as current liabilities in the balance sheet. Another important term for us to learn is cost. Cost is an amount of expenditure incurred on a product or an activity required to run for a business. Examples of cost could be printing and stationery cost and the electricity expenses incurred for the operations of the business. The term discount is an important business term. Discount allows customer to pay lesser than the original price of the product or a service. Discount is the difference between the original price and the actual amount paid by the customer. Discount is also called as rebate. Discount is of two types, trade discount and cash discount. Let us discuss trade discount in detail. When the seller offers rebate to a customer basis sales value or the quantity sold, it is considered as trade discount. When trade discount is allowed to a customer, the sales is recognized or booked as net of rebate offered. Let us understand it with an example. Say a business offers a conditional discount of 5% if the customer buys goods worth more than INR 50,000 in a single transaction. Now the original sales value is INR 50,000 and the agreed discount is 5%, which amounts to INR 2,500. Therefore, the net sale in this case will be INR 47,500. In this example, customer will pay INR 47,500. This is a case of trade discount. The business will book the sales as 47,500 for this transaction. Now let us talk about cash discount. It is a discount which is allowed to a customer to encourage to pay on time. Cash discounts are very common and are offered to the customer to pay before due date. Let us look at an example. Business sold goods worth 60,000 rupees to a customer on 60 days credit. Now the original sales value is INR 60,000. The amount payable after 60 days by the customer is also 60,000. Now the business offers a special discount, say 5% if the customer pays before 30 days. And if the customer agrees, in this case, now the customer has to pay only 57,000 to settle INR 60,000 due from him. In this example, business will book the sales for 60,000 and a cash discount of 3,000 as business expense. Business term number 27, which we will discuss now, is voucher. A voucher is nothing but a documentary evidence of a business transaction. A voucher not only documents the details of a business transaction, it also is an evidence that the transaction has actually happened and it is not fake. Few examples of voucher are invoice, receipts, debit notes, and credit notes. Let us now discuss the term business entity. Business entity is a commercial entity established in accordance with the local laws where it operates and exists with an objective of making profit. A business entity could be of three forms. First, sole trader business. Second, partnership. Third, a company. Next term which we are going to learn is the sole trader business. A sole trader business is owned by a single person. Proprietorship is another name of the sole trader business. Single person who owns the business is called a sole trader or a proprietor. The term debit and credit are the two pillars which holds the entire double entry accounting system. We have learned this in chapter 1 that under double entry accounting system, for every business transaction, one account is debited and another account is credited with the same value. The general rule is that all the expenses and assets are debited. They are credited only when they need to be reduced. Similarly, all revenue, liabilities and equity accounts are credited, and these type of accounts are debited only when they needs to be reduced. Therefore, always remember debit the respective accounts when assets or expenses increases and the liabilities, equity or revenue reduces, and credit respective accounts when liability, equity or revenue increases and assets or expenses reduces. This principle has been captured in the table summarized on your screens. Remember this table. This is the basis of double entry accounting system. You have heard about these three terms, profit and loss account, balance sheet and cash flow, multiple times till now. Let us now increase our knowledge for these terms. Purpose of profit and loss account is to ascertain the profit earned or loss incurred for a business during a accounting period. Purpose of balance sheet is to provide the financial position of the business. Purpose of cash flow is to provide information related to cash flow status of the business. Profit and loss account is prepared for an accounting period of 12 months. However, it can be prepared for a shorter period of 1 month, 1 quarter, half yearly also. Balance sheet is always prepared on a particular date, generally as at the last day of the accounting period. Cash flow is also prepared for a period, generally for an accounting period of 12 months. Profit and loss account is also referred as period statement as it reports financial performance for a period. Balance sheet is also called a position statement as it reports financial position of a business on a particular date. Cash flow is again a period statement as it reports the movement of cash over a period of time. Both P&L and balance sheet are referred to for preparing the cash flow. Revenue, expenses, and net income are the components of profit and loss account, while assets, liabilities, equity are the components of balance sheet. Cash flow components includes opening balance, closing cash balance, plus cash inflows and cash outflows. The equation of profit and loss account is net profit is equal to revenue minus expenses. For balance sheet, the equation is asset is equal to liabilities plus equity, and for cash flow, the equation is opening balance plus inflows minus outflows is equal to closing balance. Next term which we are going to learn now is the term depreciation. Depreciation is gradual reduction in the value of the asset due to its usage or passage of time or its accident. The term depreciation is related to fixed assets or non-current assets bought by the business to drive benefits for a longer period. Both tangible and intangible fixed assets are subject to depreciation. Over the useful life of the fixed asset, proportionate cost is charged to the profit and loss account as business expense. Let us understand the term depreciation with an example. Mr. X, who runs a home delivery business, has two bikes costing $10,000 each. Expected useful life of the bikes for the business is say 5 years. In this example, the total cost of the assets $20,000 will be charged to the profit and loss account over the useful life of the assets, that is 5 years. Therefore, an amount of $4,000 will be charged to the P&L as depreciation every year for 5 years. The value of the asset every year will get reduced by the amount charged to the profit and loss account. In question and answer section, let us try and answer few questions related to the business terms. Question number 1, what is a cash transaction? A business transaction which is settled immediately in cash is a cash transaction. What is a credit transaction? A business transaction which is promised to be settled at a future date. Question number 3, what is an intangible asset? The asset which do not have a physical existence is a intangible asset. Question number 4, give 2 examples of tangible assets. Building and plant and machinery. What are the 2 classes of liabilities? Current liabilities and non-current liabilities. Give 2 examples of current assets, cash in hand and inventory. Question number 7, an entity or a person who owes money against the sale of goods to the business is called debtor. Question number 8, true or false, a liability arises because of cash as well as credit transactions. It is false. The liability arises only in case of credit transactions. With this video, we have completed Chapter 2, Basic Accounting Terms. Our next video on 12th October is a special one. In this video, we will revise Chapter 2 with over 50 plus questions and answers. If you like the content of our videos and our way of explaining the topics, please do like and subscribe to our channel Accounting Buddy. Please do not forget to press the bell button so that you don't miss any new posts. Thank you and goodbye.